Hi everyone, I'm Amber. I'm a venture manager at New Order. I'm managing all the DeFi projects in our accelerator program called DeFi Base Camp. So that's a program in partnership with Outlier Ventures that's designed to help early stage projects to grow and launch in 12 weeks, give them all the connections, capital, and know-how for them to be successful and bringing new innovation to DeFi. So we have recently graduated 6 teams, and Sumeria is one of them. We have one of the founders and CEO, Sai, with us here today. Welcome, Sai.
Thanks.
So the long-term vision, as I understand, of Sumeria is to build a decentralized financial infrastructure for NFTs, or a one-stop liquidity protocol for NFTs. And they start from building a debt market, a NFT lending and borrowing platform, where the NFT holders, they can pledge their collections to get liquidity, and liquidity providers can supply the capital in return for interest payment. So that definitely, increased the capital efficiency for NFT space as a whole. But on top of that, Sai, I know that you're also building a suite of products to not only increase the capital efficiency, but also lower the entry barriers for users to buy and trade blue chip NFTs. So we'll get into all those products in this interview. But first of all, Sai, it's good to see you here again. Can you tell the audience a bit more about yourself, your background, and when did you start working on Sumeria?
Yeah, sure. Thanks, Amber. I think for a very good explanation or introduction of Sumeria Labs. Hi guys, my name is Sai. I'm the CEO of Sumeria Labs. So personally, I came from a traditional kind of like investment banking background, like working at the investment banking industry for around 10 years. Before I start investing and researching, I think in the crypto space back in 2016, 17, worked for a crypto startup in Hong Kong, invested in the very early stage, like first generation of the DeFi protocol, including Compound, ETH Land, which is now called Aave, like the first and the top kind of like DeFi. It used to call ETH Land. Interestingly, I think our tech advisor, it's also it's the first developer of ETH Land. He's now guiding us, I think, to build this new DeFi infrastructure for the NFT space. So yeah, I basically think I've got 15 years kind of experience in the financial space, 10 years at the investment banks, and another 4 or 5 years in the crypto space. Before that, I also, I think, in VC for 2 years, investing in deep tech startup, including blockchains. Personally, I invest in a couple of GameFi projects as well. So last year, I was working with my co-founder. He got a very interesting background. He used to be a professor of contemporary arts in the US. Used to teach students at Wellesley College, I remember correctly. So he's very close with the creative industry in the US. He did a lot of crossover exhibition with the artists and musicians in the US before all the NFT hype. So he's very well connected in the space. He was working on an NFT project last year, and then he hired me as a token economist, I think, for the project. And then we tried to kind of figure out how to design a token and also over incentive for the project owners, the people holding the NFT, not to kind of sell their NFT in the market after review, trying to kind of lower the price of the NFT into market and then manage the floor price. So we tried to, I think, research the financialization space, the NFT financials. We didn't find a lot of tools people could use to get liquidity from the NFT holdings, and so that's why I think that this is the original idea that we came up with, trying to do something that allow NFT holders not losing their ownership, while I think that they would be able to get liquidity from their holdings and use the capital either for reinvestment or paying the taxes, I think, especially those holders in the US. So we do see demand, I think, from NFT holders. If we look at earlier this year, we saw NFT-Fi, which is a very successful project using a peer-to-peer model, and it kind of I think proves that the product market fit. But the thing is, using a peer-to-peer model might not be very scalable. And also I think that the market kind of lack of a standardized way to calculate the credit risk, since this is a relatively new market. So I try to kind of see if I could like leverage my previous experience in the investment banking in the banking industry, try to apply those like risk model in the DeFi space to manage NFT, because like the nature or the features like of NFT is very different from cryptocurrency. Like cryptocurrency, you can easily using a marginal kind of like business models, like treat them as like stock shares, like you can easily get the liquidity, I think, from different protocols. But NFT is like by nature is like less liquid. So the liquidation part is like very difficult. Like you can use the same methodology as like the cryptocurrency. So we have a relative kind of like unique novel risk management design. So that's why we position ourselves as NFT investment bank rather than a lending protocol, because the product that we are offering basically it's like a structured product. We have a junior tranche, a senior tranche, and senior tranche as a safe kind of like yielding products, and the junior tranche is like high risk but also high return kind of like products. Try to segregate the risk, like, and also do some segmentations of different type of like investors. So they allow us to kind of like kind of like handle the liquidation smoother, I think, than the existing other protocols still using the compound or alpha weight of like handling the liquidity risk and also the credit risk.
Yeah, great. Thank you, Sai. So I think NFT lending is a very intuitive product, which means it's a very popular area for innovation. As you mentioned, there are some competitors in this space, like NFT-5. So what do you think makes Sumeria or Zumer stand out?
Well, I think like I just like mentioned about like in terms of like how we manage the credit risks and how we design the product is like slightly different. Like if you look around, I think the existing kind of like NFT-backed lending protocols, like using a peer-to-peer protocol models, like for example BendDAO and JPEG and a couple of the others like up and coming ones. We look into their code. So basically they're forking compound or RFAs. They still use the money market model to manage NFTs. Like, but our model is like different. Like we use a traditional kind of like banks underwriting models in that instead of like margin loan kind of like brokerage model. So that's why as I mentioned, like we segregated the risk, and then we would also require people to lock up their capital, I think, for a period of time, so that we could match the long duration. So we don't have to kind of like use the utilization-based interest rate models that drive concentrated liquidations, like which kind of like in a bear market might create like liquidity squeeze, like it's what's happening, I think, currently, I think, for one of our competitors. So I think,
yeah.
Sorry, go ahead.
So I think you're referring to in August what happened with BendDAO, because the ETH price rise, it kind of erodes the NFT collateral value. That's why it triggered a large scale liquidation in BendDAO, and which is similar to a bank run, I guess. Their liquidity dropped like 50% over the weekend. So you're saying by locking up lender liquidity, it kind of avoid this problem. Is that how Sumeria is solving this problem?
Yes, I think like if you look at the interest rate model, I think for the current NFT-backed lending protocols such as like BendDAO, well, as I mentioned, they use the compound like model, right? Which basically means their interest rate is determined by the liquidity of the liquidity pool, right? The lending pool. So the tighter the liquidity, like which means their utilization rate, the higher the utilization rate, the higher the interest rate. The reason for that is like because they like to drive the liquidations of those lending positions, like to get at the liquidity and pay for the liquidity providers. And so because the higher the utilization rates, if people like want to get back the capital, they might not have enough capital of the protocols, right? So that's why they need to use a high interest rate to force the liquidation in order to get back the capital. So that's the existing DeFi models. Like most of the, I think, the lending type of DeFi model are using this utilization driven interest rate model. But this model, I think, it has a soft force. Like it's good to manage very liquid kind of like money market alike assets, like such as like cryptocurrency, but it's not good for NFT because NFT is like very illiquid. And if you use this model, you basically would force concentrated liquidation, which means you increase the interest rate significantly, or your lending position would force liquidates, like especially those are very close to their kind of like liquidation fractions. And if you like liquidate a lot of like positions like together, you basically would create squeeze, like market kind of like impact, like impacting market price or price liquidity, and then you create a negative spiral to the price of the NFTs, like which kind of like drive the bad loans, like the amounts of bad loan higher, which I think it's the software I think of the existing business model or the kind of like DeFi model. So what we do is like we try to offer the borrower a fixed rate, which is not driven by the liquidity situation of the protocol, by asking the liquidity providers to lock the capital, I think, for a period of time. Like because like we have two pools. One is like without lockup, one is with lockup, and then we use the lockup position to manage the liquidity. And so you can imagine this was like as I mentioned, it's like structured products. Like one is low risk senior tranche, one is like high risk junior tranche. But you have to lock up. But in order kind of like so we have one more additional layer of liquidity. So all your sticker positions like would be denoted in NFTs. So we are basically I think issuing NFT bonds like for your position. Like so I think like most of the DeFi users, they kind of like they understand like if you stick your crypto, you get a C token, I think, from the protocol, which is like a certificate of your staked positions. But for our protocol, we actually issue you NFTs, like which is like a certificate of bonds like, of your holdings, and then you can trade that in the secondary market. So even though you lock up your position, but the NFT you got from our protocols like that represent your sticker position actually could be also traded in the secondary market. So kind of like over a second layer of liquidity for those like sticker positions. So so this is like how our model works and how we differentiate it from the others, like just like purely using a margin loan models, like while we basically are building an ecosystem like an investment banking kind of like. And also we try to build more kind of ecosystem partners, like how else to handle the liquidation, and also offering other type of like utilities, like such as like we are talking to a few NFT leasing company, like so after people pledge the NFT with us, we could actually lend out the NFT like for like leasing purpose, like people could use the NFT I think for use the utility whilst not have to own that NFT. Yeah.
Right. I think a lot of you spoke a lot about a lot of things that we can a lot of things to unfold here. One is what you mentioned. I thought it was really interesting is this dual pool approach. So you're saying as a liquidity provider, I can choose a different tranches of like which pool I put liquidity in. So one is like regular liquidity pool that's lower risk, lower return, and it's and you have another pool called I think it's called a provision pool.
Yeah,
right?
professional pool. Yeah, it's called also the underwriter pool. It's like basically like a set of like liquidity provider would love to underwrite the credit risk, which means they could absorb the price volatility during the liquidation process. Like once we liquidate with losses, they are willing to absorb the losses, but in return, we are giving them a high yield. Like for example, we're giving them 15 to 20% kind of like yield. So if you calculate, if you like based on a kind of like through the cycle kind of like default kind of like experience, if their position is long enough to kind of like experience a full credit cycle, the risk-adjusted return will still be attractive. So so this is the reason why we kind of like prefer them to lock a longer period of time, and to incentivize people to lock into the underwriting pool as an underwriter to absorb the risk. We will offer them our token kind of like incentive. They will be able to mine our protocol tokens, which is also I think a way that share back the protocol income or earnings with those like underwriter within the ecosystem. So like we got like different risk management kind of like pool, and then at the same time we also have like incentive aligned like for people to like pick their side to provide liquidity. So for the kind of like safe, like low risk pool, like basically it's principal protected, because as I mentioned, most of the price volatility risks would be absorbed by the underwriter, which is the provisioning pool.
Yeah. So tell me if I understand wrong here. So for the provisional pool, there are two sources of capital. One is from underwriters. The underwriters, because as investors, they have different risk tolerance. The underwriters can opt in this higher risk, higher pool. The higher risk means that if the value of the NFT falls below margin, that pool will be liquidated first. And that's one source of capital. The other source of capital is I think you also charge a additional interest on the NFTs, which is what you call a credit cost, right? And that cost using the average default rate on the other NFT lending protocols. So in a way, it's protecting the underwriter's liquidity as well.
Yes. So the yeah, I think you mentioned a good point. Like so we also, I think I'd like to discuss a lot more about the credit cost. So credit cost, basically it's like how bank underwrite the loans. Like for example, when bank give you like 10,000 credit limit for your credit cards, they charge you, I think in the US they're charging like 30-something% annualized interest rate, right? So basically they expected 30% kind of like default rate for your credit cards. And if they manage to kind of like achieve lower than that kind of like credit cost, they earn the margin. Like this is like how bank they make money from like giving you a credit, right? So so that's why we have to kind of like price in this like default tendency of like people in the NFT space and into the interest rate model. So for example, like if I have the Bored Ape, like but the industry-wide default tendency of holding a Bored Ape, like and get a loan, so like it's about 10-15%. So we have to include this into the interest rate model that we charge at the first place when you get the loan using your Bored Ape. And this amount like would go to the provisioning pool, because the provisioning pool it's basically built for kind of like build a buffer to anticipate future default, so that we could use this to absorb the losses. So this is like how the like we call provisioning pool or the underwriter pool work.
That makes sense. So instead of the traditional bank model where they will pocket that additional like credit or default risk in the form of interest payment, you're actually sharing that interest payment with or acting as a buffer to absorb the possible future losses with liquidity provider. That's kind of like added the security layer for liquidity providers.
Yes. Basically, I think it's kind of like a advanced kind of like risk management model. I think on top of the existing DeFi kind of like the risk management framework, we added the credit risks and also invented the underwriter roles that allowing like different people to act as an underwriter of that particular NFT lending financing pools. Because like in real world, usually I think that the underwriter would be a bank or an investment bank, like they underwrite your debt offering, right? But in DeFi, like we try to decentralize, I think all the components, like even the reserve actually could also be decentralized, is as long as you provide enough incentive, like people, like as I mentioned, like that pool, they would earn a high yield. And at the same time, like liquidation, like if we, like say for example, people default, but the thing is like because they have collaterals, so the default position will not kind of like depleted, because like we have the collaterals, we could liquidate the collateral in the market, and we still able to kind of like get back some of the like money back, right? And in a well-designed kind of like liquidation model, sometimes we might be even I think able to generate returns like from our liquidation, and all this return will go to the provisioning pool. Like the underwriter actually I think would enjoy the P&L of the liquidations. So losses, they absorb losses, but if it's gain, they also I think enjoy the gains as well. So in our current kind of liquidation models, like we offer around 20-30% kind of like liquidation buffer. So as long as the market price is like reach like 30% of your debt values, like we would trigger liquidations. So that we have enough room, I think, for the liquidator to kind of like do the arbitrage. Like they take over the debt position from our protocol, give us back money, and then they liquidate in the market and to earn this like 20-30% kind of like gains.
That's awesome. So another thing you touched on was that the secondary market you built for this NFT loans. So I'm thinking beyond the lending and borrowing exchanges, lending borrowing platform, what are some other features of Zumer?
Well, yeah. So apart from like collateralized lending, so we are now I think working on a buy now pay later products, not just like serving the blue chips. Like of course, like we could like use the similar kind of risk management model to offer loans like in advance, like people without owning the NFT, but they can use our loans to buy the NFT they like. They just have to pay like 30%, 40% kind of down payment and get loans to buy the NFT they like. And also, we are now looking at some GameFi kind of like space, trying to kind of like help the gaming company or even like gaming guilds to fully utilize the NFT, because I know gaming guilds actually they hold a lot of like gaming NFTs, right? And if we could help them kind of like securitize their positions, while they would still be able to lend out their NFT to the scholars like for playing games and get some interest income. But actually, I think that they could do a securitization of all their NFT, and which is like financing models. Like using our protocol, we could do the securitization, and then we have like two church, right, help you segregate the risk and give you capital, and then you can. So for the gaming guilds, they could use those capital to reinvest in other games NFTs and continue to generate recurring income. So basically, this is like a leasing plus securitization model. So this is something our protocol will be able to offer. I think the next version, like and it's a very kind of like interesting area that we're now looking at, because we look at the metaverse gaming kind of like investment from VC the past 6 months. Like it's kind of like also I think it's record breaking again, I think from last year. So this is like a very kind of like high growth area that we are now looking at.
Yeah, that makes a lot of sense. So you're building a secondary market for NFT loans, and also buy now pay later feature for people to be able to buy like larger ticket NFTs, and on top of that, also like in-game assets NFT renting protocol.
Yes.
That's awesome. So I remember you guys have a Zumer token. What can you tell us about Zumer token? What's its utility? And will that be a TGE we can look forward to?
Yeah, it's cool. Good question. Like, so our protocol token is called Sumer, like just like the name of our protocol, and it's a utility-based token. So we don't, because like SEC kind of like now it has a very restrictive kind of regulation in the US. We try to avoid, I think, having security-like features. Like, so we don't do profit sharing. But there's a way that we can get around this, like I can share later. So the first utility of our token is like for payment purpose. So our protocol, like for each loan origination, we charge 1 to 2% underwriting fees. Like so for borrower, if they want to get a loan out, like apart from the interest payment, they have to pay on an annualized basis. They have to pay a one-off fee, like which is 1 to 2%. And they could choose to use our protocol token Sumer, like for that payment, and then they will get discount. Or they could choose like to pay through Ethereum. It's actually also okay for us. Like, so depending on like how they want to choose, I think, in terms of payment. But this is like the first utility. It's about like payment. And second utility is governing. Of course, like this is like pretty obvious. Like we adopt the curve kind of like the V token models, like allowing people to stake and get the V tokens. The longer you stake, the more V token you get, and so you have more kind of like voting power. And what kind of like stuff they could vote, like including like which NFT project would like to support, what kind of like risk policy we would like to adopt, liquidation thresholds, like those economics kind of like policies. And on top of it, we could also allow the V tokens holders to kind of like vote to route our protocol income to one particular financing pool, like to boost the return of that particular financing pool. So it's pretty much like curve kind of like model, like create curve war. Like we might have like sumo war, like if people like they could choose how to route our protocol income. So that's the key utilities of the token. And apart from the token, we also have our protocol NFTs. Like we're gonna have a pre-launch soon, and then we are giving out some free NFT to our early kind of supporters. Like just like stay tuned, follow our tutors, and you'll be able to participate in the campaign and get free NFTs. So the NFT would be like a would have a higher seniority of the tokens. Like if they have the NFT, their voting power would increase by a certain percentage, something like that, and also enjoy discount of using our protocol with the NFT. So it's like kind of like VIP membership card. So I think that this is also the features that we would like to give to our community members, like try to incentivize people to participate, more engagement, and also I think we sharing I think the protocol income, like use other method, but not profit sharing, which would might, as I mentioned, I would make our tokens as a security and then will get investigated by the SEC. So we have a different kind of like methodology here, try to kind of like maintain the utility kind of like features of the token.
That's awesome. So I understand that, by the way, very much looking forward to the NFT drop. So I know you guys launched the testnet recently and got a loan from Polygon. So what's the roadmap from here? When is the mainly launch?
Yes, so we have our NDP on the testnet for a while. Insiders, our investors have been like trying and giving us some feedback. So we're looking to have a beta launch, like fully public, end of this month. We're still on testnet, but it's open to public. Like people like whitelisted will be able to kind of like use and give us feedback. We will have a bounty program, I think, after this beta launch as well. Try to spot any kind of like bots. We're looking at end of this year, like around November, December, we'll be able to fully launch the protocols on the mainnet. We've already finished, actually close to finish the smart contract audit. So this smart contract science pretty much done, kind of like try to gain insight into the security of the protocols. So the first audit would be done, I think, in a week of time, and we're looking to start the second audit. Like I try to, I think, collect more feedback, I think, from the professional audit firm. And also, we mentioned about the NFT drop. Like we would kind of, we're looking to fully drop that in October, like a few months after the protocol kind of like beta launch. So that's this year's roadmap, and then next year we are looking to expand our protocol into other layer one chain, like Polygon is one of them, and then we also I think are figuring out like some layer two solution, like if the transaction kind of like the traffic kind of like picks up, if the kind of like transaction costs increase like significantly, I think we would try to use some layer two solution, I think, to lower that borrowing cost for our users as well. So expansion, I think, into other change would be early next year's kind of like key KPIs like for our team. Yeah, I think that's, and also I think the GameFi kind of like the securitization products that I mentioned, I think will also be looking to launch first quarter or first half next year.
Sounds great. So if we can change gear a little bit here, you recently went through our DeFi Base Camp Accelerator program. So tell us, how was your overall experience?
Well, it's actually very helpful. With like fans like Amber as well, very engaged, giving us a lot of opinions, kind of advice, especially I think during a bear market, like because the sentiment it's pretty kind of like bearish. Like when you talk to a lot of like investors, like we actually I think got a lot of investor introduction from Order and also Outlier Ventures. Even though I think that they're having a kind of a wait and see attitude I think currently because of the market condition, like but still I think a lot of like good recommendation, not just like from Order and Outlier Ventures, also from those potential investors as well as like guiding us like to in terms of like customer acquisitions, like marketing, like tokenomics, like how to kind of like fine tune the tokenomics in a bear market. And also I think we adjust expectation. I think it's also I think very important. I think for founders like and understand I think the market more and try to pivot. Like I think this is like very important as well. Like well usually I think like especially I think for technical founders like us, like we're all I think with a very relatively I think technical background, less kind of like our marketing backgrounds. Like we always I think products is the first, right? But after then camp, we realize also I think business developments, like how you sell your products, execution is also I think the same importance. Like so yeah, I think this is like what we learned I think from the camp, and very valuable experience and resources from the Order.
Thank you so much for your kind words. Yeah, I think we New Order, of course, with our very close partner, Outlier Ventures, we are project makers ourselves. So we recognize how much problems as a founder you need to tackle every day, and want to give them all the help you need. And especially, I think in DeFi, you know, the speed to market and how the market change. It's really important to be flexible and to be able to pivot, as you mentioned, to be an agile project. So that's great. So you've been on this founding journey in Web3 for a few years. I'm sure you have a lot of good experience to share with the aspiring entrepreneurs. And so my last question to you is, what's the one piece of advice you have to share, to give like future DeFi founders?
Well, I think gone through the last kind of like bear market, and that's actually I think the best time for innovation. And this is like how the first generation of DeFi got invented. And I remember I think when like ETHLand first kind of launched, it's not even I think there was no DeFi this term, right? And I remember I think because our advisors like he built the first version of ETHLand, and he told us. As you remember, I think they basically was using a peer-to-peer lending models, and they didn't I think have a permissionless mechanism. They record or they actually book all the transaction using an Excel, and using kind of like using phone call to kind of like take the orders, like take the lending and borrowing orders, like. So this is like but eventually I think they became one of the biggest DeFi nowadays after a few years kind of like of the development. So I think for me, I think for entrepreneurs, always try to find what the market like wants, like, and also I think like be more innovative, trying to I think figure out I think new models, like, because I think products always a way that could to improve kind of like user experience. And what I'm experiencing is like the Web3 so-called the Web3 kind of like populations, like they are still very kind of like lynched. I think the populations, like in order to kind of like increase the reach of the crypto, we might have to kind of like adopt a more user-friendly kind of like user experience. So yeah, innovations like listening to customers, like try to improve your user experience is like a very important thing. At this moment, I think especially in doing a bear market, and if you want to increase the target audience of your products.
Thank you so much, Sai, for being here with us today. It's been a pleasure, working with you throughout the program, and happy that we are, able to help a little bit. And I very much look forward to your mainnet launch soon.
Yeah, same here. We are kind of like working very hard, I think, to reach kind of like to achieve our KPI. Like so far, I think we've actually, I think we are able to kind of like follow our roadmaps, like as promised to our investors. Like we're launching our testnet this month, and then our final kind of like full version on the mainnet before this year end. Yeah.
That's awesome. So last thing, DeFi Base Camp is still accepting applications, but it will be closed soon. So if you're founder building in DeFi, please put in an application today, or leave a comment on social media channels, YouTube or Twitter, and we're happy to talk to you. Thank you, Sai, and I'll see you next time.